First of all, welcome and thank you so much for coming today. A quick little bit of background about how this came about I think might be helpful in setting up this panel. Until about 3 weeks ago, I was policy director and counsel to the House Majority Leader, Kevin McCarthy. And back in December or so, a few of us had lunch. And the whole notion of doing something on the regulatory reform issue like this came up. And my own kind of confession here is that from my vantage point for the last couple of years, I was overly impressed. I was so impressed by the bills that were being moved through and passing with some relative unity on the House side, tackling regulatory reform issues. And I thought it was an underappreciated line of work because the more I looked into it from a sort of an amateurish level of sophistication, the more I appreciated that regulatory issues writ large ought to be thought of in the policy realm pretty much on a par with entitlement reform or tax reform. It was that big of a deal. It was something like $2 trillion a year of overall burdens on the economy, according to various studies. It was approaching the scale of maybe what we collect through the tax code. But I thought that it was one of these areas that people tended to shun because it had this reputation of being really boring and geeky and in the weeds, and how do you really translate this? So the idea in a way is to find venues like this to make those of you who work on the Hill and around the Hill appreciate the gravity of what's going on, why, as Matt Spaulding would have laid out earlier, why it's so important to the progressive view of government and individuals in society, and what we ought to be doing about it. And so that led to this kind of a program, and I think we've got a great, two great experts here to flesh out what it means. And the idea was to lay it out in general through Matt, and then a panel to look at the economic impacts, but then hear what it means for people. And this is the part that ought to be the way to get audiences of constituents and stakeholders back in your congressional districts and states to appreciate what's going on and maybe feel a need to look into it further and to understand and appreciate the stuff that's going on the Hill in this venue. So that's just my setup for two very accomplished folks today. And what I'm encouraging you to do is think about this issue and get excited about it. I want you jumping out of your seats and screaming and cheering. I know Susan will be doing that. So anyway, thanks for being here again, and looking forward to the presentations.
Great. Thank you, Mark. Well, thank you, Michael, and thank you all for joining us today. It's a real pleasure to be working with you again. I know I see a lot of familiar faces in here, and hope to meet some folks who I haven't had a chance of talking with yet. I want to tee up my presentation in the context of regulatory opportunities and difficulties in the context of secular stagnation rerun. Kind of a long title. What is a secular stagnation rerun? It's a story that we've heard before. It's a story that we heard starting in the Great Depression. It's a story about, hey, maybe this is as good as it gets. It's a story that is used frequently to rationalize distributive regulation rather than regulations that create economic opportunity. We hear that story again today. We hear the term secular stagnation. It's making a comeback. And the reason I highlight that is it seems politically, at least, it seems to be a very durable story for regulation. And if we listen to some of our previous speakers, Matt Spaulding is arguing we want to get back to politics. We want to get decisions back to the local information. That's certainly the right way to go. And but I'm highlighting the secular stagnation story is that if we listen to Bill Beach, he's saying, hey, we have to have answers. We have to have answers to the secular stagnation story. It rationalized bad regulations in the aftermath or during the duration of the Great Depression. It is being used again to rationalize bad regulations as we sit here today. How does an economist think about good and bad regulations? What is a good regulation? Regulation can be good. Regulations that economize on the cost of transacting are good. What does that mean? It's costly. If I have something you want and you have something I want, it's costly for us to find each other. Monetary policy, which I'll talk about toward the end of my talk, is very important for avoiding that coincidence of wants. You might like economic lectures. I might like coffee, right? If that's the case, we're in business. We don't need money. But if we don't have that coincidence of wants, we need something like a claim check to facilitate that trade. We need good regulations, price stability, so that we know that that claim check is going to hold its value over time, that we trust it, that it's going to get me what I want without incurring too much in the way of transaction costs. It's rules that help us come to terms of agreement, and it's rules that enforce those terms after the fact. Regulations that economize on each of those three dimensions of transaction costs, those are good regulations. They facilitate mutually beneficial exchange. They expand economic opportunity. Professor Boudreau just talked about the problem of knowledge, the knowledge problem. The economy is incredibly complex, and he's absolutely right. A difficulty with regulation is that it's ignorant, right? It's a knowledge problem. And if that was the only problem out there, things might not be too bad. Right? For economists, being ignorant isn't bad per se. It just creates errors in your judgments. Sometimes you're wrong this way, sometimes you're wrong that way. All else constant, you'd like to be more precise in your regulations, but now you've got a broader set of consequences of your regulations. You're just ignorant. I worry less about that than I do about the door opening to distributional interests, right? As we slice the pie, rather than grow the pie, crumbs keep dropping to the ground and the pie starts to shrink. And that's going to be my argument here. I forgot my clicker, excuse me. I want to highlight what's at stake here. This is a timeline from post-World War II until today. And you see that the US economy grows on the blue line at about a 3% trend growth. And it's a stable trend. You look at the early 1980s, that's a double dip recession. That was huge. Bounced right back. You look at today, we're 6 years into a recovery, and we are still $1 trillion short of our potential. People, that is $1 trillion per year. That's not $1 trillion one time. Each of the last 6 years, we've fallen $1 trillion short of our potential. Coming out of the Great Depression, what was the story? It's a secular stagnation. There's not much we can do about it, but hey, here's some demand-side policies that could help. Here's some regulations that could help. Maybe without those regulations, maybe without those demand-side policies, maybe it wouldn't have been the Great Depression. Maybe it wasn't a great stagnation, maybe the secular stagnation, maybe it was a policy depression. We hear a similar story today. People look at this picture, well, this is the new normal, right? We have demographic forces working against us, demographic headwinds, we hear that word a lot. We've plateaued in the level of educational attainment, another headwind. This is just the new normal. That's what we're told. We couldn't possibly get back to trend growth quickly after such a bad recession. Hey, the alternative is maybe the policies, maybe the regulations aren't realizing the opportunities that I highlighted. Maybe they're not economizing on the transaction costs. What they're maybe doing is increasing transaction costs. When you increase transaction costs, rather than free exchange, mutually beneficial exchange, allocating goods and services, you need somebody to tell the goods and services where to go. If I'm a politician, I like that, right? I'm against low transaction costs. That's the fight that we're in. How do you promote economic opportunity when it's politically difficult? And that's what I want to help equip us with, the tools to think about that. today. And one example that I want to share, we heard from the last panel some illustrations from the labor market. I'll start with labor market illustrations and with some financial services and monetary policy implications. What do we want to do with labor markets? We want to make it easier for employers to find productive workers. We want to make it easier for them to come to terms of agreement and then enforce those terms after the fact. What do we do instead? We make it harder for employers to hire people, and we reduce the rewards to working. About a quarter of this $1 trillion gap can be rationalized by the drop in labor force participation following this last recession. About a quarter of that $1 trillion gap can be rationalized. Again, what do you want to do? You want to make it easier to hire people. What do we do? Look at the ACA. Casey Mulligan, University of Chicago economist and Mercatus scholar. He highlights that for large employers hiring people without health insurance, they're penalized $2,000. Notice what that does. We're talking about mutually beneficial exchange. It creates a gap between, say I'm a $30,000 productivity guy. If you got to pay $2,000 extra for me, I'm in no man's land, right? I have to jump all the way to $33,000 to be an attractive employee to you. You say, well, look, just offer the insurance. Well, there's another gap. The taxes, or the after-tax cost of the benefit to the employer is different than the after-tax benefit to the employee. So just to jump ahead, if you sort of do that math, as David Henderson at a Hoover Fellow has done, he estimates that the after-tax cost for a $15,000 benefit to the employer is in the neighborhood of $13,000, $14,000. The after-tax benefit to the employee is about $10,000, $11,000. Again, you see there's a gap there. If I value the benefit, say, at $11,000, right, it's jumped over my after-tax hurdle, but it's not enough for the employer. Again, there's a mutually beneficial exchange to be made there, but the tax regulations are creating this no man's land where a lot of people are getting stuck and simply not participating in the labor force. And that's a quarter of this gap. One more point on labor markets. Imagine you're a single mom. You're making $30,000 a year. You're doing a great job. You go to work. It's your annual review. Good news. Boss wants to double your pay. $60,000. Not so good news. The benefits that you would have to give up in Pennsylvania would have to make you scratch your head. You'd have to make $70,000 to make up for the lost benefits. And this is another great insight from our friend Casey Mulligan. Taxes and benefits are the same thing. If you have to pay $15,000 in taxes, or you lose $15,000 in benefits, you don't care how you lost it, you just lost $15,000. And so when you have to jump these hurdles, these huge gaps between where you are in life and where you want to be, it stops people from reaching for their opportunity. That's where this $15,000 gap could be coming, this $1 trillion gap could be coming from. We don't need to rely on a secular stagnation to rationalize this gap. There are very good policy reasons for why we may be seeing this. Let me turn the corner now to financial services and then wrap up with monetary policy. People who didn't think that financial services mattered for economic opportunity before 2008 know that it does now. What do we want to do in the aftermath of 2008? We hear a lot about too big to fail. too big to fail. So let's think about that. If you were going to respond to too big to fail, what would you do? One thing you would do is you wouldn't promote bigness. You'd want competitive financial markets that regulate the size of banks. Lloyd Blankfein recently, he seems to favor regulation. Why would Lloyd Blankfein, the chairman of Goldman Sachs, why would he like regulation? Because he's big, right? You've got to be really big to be able to swallow the regulatory costs. It's a competitive advantage. The regulation is a competitive advantage for the big guys. How about the fail part? How do you fail? Well, we don't really care if one bank fails. We care if a lot of banks fail together. How could they fail together? Well, they could fail together if they're all invested in the same thing. So we would want rules that say, hey, you've got local information, you make your bets. I have local information, which differs from yours. I'm going to make different bets. So now we've got uncorrelated bets. If you go down, I don't, and vice versa. What did we do instead? We have asset-based capital requirements. Now, rather than you relying on your local information of what's a good risk-reward, and me relying on my local information of what's a risk-reward, we have a rule that tells us what the risk-reward is. Now we're holding the same assets. We've increased the risk of failure through these kinds of rules rather than decreasing that risk. And the last point I want to cover here is monetary policy. How do we regulate our monetary authority? Remember the three dimensions of transaction cost. The first one is, if I want coffee, I've got to find somebody who likes economics lectures. If that was true, I'd never have my coffee. What solves that problem? It's those little green pieces of paper that we walk around with. It's our claim checks. For some reason, the good people at Mercatus pay me to talk about economics. I love it. I get little green pieces of paper, and it solves the coincidence of wants problem. My barista doesn't have to know anything or have any desire to learn economics, and so I get great coffee all the time. It's fantastic. Why does that work relatively well? It works relatively well because we have price stability. Not everybody here was alive in the 70s. Some of you were, I was. I mean, there wasn't price stability. If you look at a country like Brazil, Brazil's countries in South America have experienced hyperinflations, anything but price stability. I mean, when you have hyperinflation, people take cabs to the bank rather than buses. Why? They get paid twice a day because inflation is going so fast. And they could save on the inflation by getting to the bank faster by the cab rather than by the bus. That more than pays for the difference between the cab fare and the bus fare. If you're spending most of your time going to the bank and protecting yourself against inflation, economic opportunity is shrinking, it's not expanding. We're not maximizing mutually beneficial trades. So let's think about how we regulate the production of monetary services in this country. It's the Federal Reserve Act. And there are proposals to reform who sits at the table and how they get to that table. And it's very important how people get to the table. How does Janet Yellen, Chairman Janet Yellen, get to the FOMC table, the Federal Open Markets Committee table, the policy-making arm of the Fed, not the arm, but the group that deliberates on monetary policy. She, in her 6 companions in the Board of Governors, nominated by the President of the United States, confirmed by the Senate. There are 12 other people who sit at that table. They're district bankers. We have 12 Federal Reserve districts in the United States. Each of those district banks has a president. That president is nominated by a board of directors in that region. That board, in large part, is composed of bankers, commercial bankers. Who loves price stability? People who make fixed rate loans. Those are the bankers. Who doesn't like price stability? Well, if I'm a politician, if I want to win an election and I'm trying to get your votes, I have a strong incentive to do things for you, but I've got to pay for them. I could tax this half of the room and give the goodies to that half of the room, but sometimes that's difficult. I can borrow and leave it to your kids, maybe a little bit easier. What if I could print money? That'd be even better, right? Just print up some green pieces of paper and shoot it out to you. That's the incentive that the 7 come to the table with. The 12, they have to report back to the price stability folks. And when you look at the data, what you find across administrations and across whoever controls the Senate that oversees the Fed, what you see is that the seven presidential nominees vote significantly looser than do the 12 that are nominated by the commercial bankers. And there are some proposals out there to change that mix of who sits at the table. There's one proposal that would have the New York bank president face a Senate confirmation. So now you've got 7 voting against 5 inflation hawks, relatively speaking. What you do is you take one of those 5 and you make that person look more like the 7, right? That would be a move toward price instability. There's bipartisan support in going exactly the opposite direction, and this is what gets me excited. So I'm frequently looked on as a pessimistic guy, having grown up in the south side of Chicago. I can't help it. Here's where I end on a happy note. President Fisher, former President Fisher of the Dallas Federal Reserve Bank, recently resigned. He's proposing that every meeting, 6 district bankers vote at the meeting. Right? It would even it out between the folks that come to the table with more of an inflationary incentive to the folks that come to the table with more of a price stability incentive. Representative in his state, Brady, he's arguing that we should have all 12 of the district bankers vote in every meeting. So now it would be 12 district bankers against 7 on the Board of Governors. Both of those move in the same direction of economizing on perhaps the most important cost of transacting, and that is facilitating just meeting the person who has what you want and being able to facilitate that exchange without having to have a coincidence of wants. Right? So I'll end there, and I'll look forward to our Q&A, and I'll look forward to being a resource for your good work going in the future. Thank you.
Thanks, Dino, for that. I just want to say that despite everything you've heard today, it turns out that regulation does not affect people at all. That's what the research shows, that people are not at all affected by regulation. You're laughing, but it's April Fool's Day, so I'm allowed to start that way. But it's that kind of foolishness that pervades the regulatory apparatus in Washington. And I would kind of dispute something that was said earlier, that these regulatory agencies are filled with people who are sort of the dregs. And it's true that it's difficult to fire government employees, so you do get some sort of stagnation in the workforce. But regulatory agencies are also filled with a lot of people with very good intentions, and they think that there's this magic way that you can regulate away bad things and you won't have any costs. People won't experience any costs at all. So I'm going to talk a little bit about how that actually works out in practice. And because my area is financial regulation, all my examples are from the financial regulatory sphere. So the first is the financial crisis. And Dino actually alluded to this. We often think of the financial crisis as being a crisis caused by deregulation. That's a great story. If we had just regulated more, we wouldn't have had this massive crisis. But looking at it a little more closely, it turns out that it wasn't deregulation after all. It was regulation that led to the crisis. And so as Dino mentioned, there are these capital requirements that tell banks what they're supposed to have in capital. How much equity do they have to have backing their investments? And so a lot of this turns on what kind of assets they hold. And so there are these rules that tell banks what kind of assets, how assets are ranked in terms of safety. And there was a decision made that mortgage-backed securities are really safe assets to hold. And rationally, it makes sense. One can argue that. But the consequence of doing that was that instead of having the local knowledge that Dino mentioned, you had all of these bankers demanding mortgage-backed securities, which means they didn't care what was in it. They wanted these mortgage-backed securities. And so that created a huge demand for subprime mortgages because we want to have as many people taking out mortgages as possible so we can fill these mortgage-backed securities. And then that combined with housing policy that said, you know what, underwriting is sort of for the old days, down payments, that was what our grandparents did, we don't do that anymore. And so there were these pushes coming from both sides, both the demand for subprime mortgages from the banks with their capital requirements, and then you had the banks also trying to meet these requirements to lower their underwriting standards. And so we got a terrible crisis. And who paid the price for that crisis? People. And people paid in really dramatic and awful ways. So we think, okay, well, how are we going to solve the crisis? What are we going to do in response to it? And we get Dodd-Frank, which was the regulatory response. But because there was this narrative that it was deregulation that caused the crisis, the response to the crisis was a very regulatory-centric solution. And it was taking decisions away from people and putting them into the regulatory sphere. And so we're going to see even more effects on people as a result of that. So for example, Dino talked about the too big to fail. And Dodd-Frank really, the folks got together in Washington and they said, okay, this is really, too big to fail is really a problem. So what we're going to do is we're going to take the biggest financial institutions and we're going to designate them as systemically important. And that way, we're going to be able to regulate them even more and make sure that they don't fail. That's the theory. But what that means in practice is that you're designating these big banks, big insurance companies, likely soon big asset managers. And so they're going to be subject to additional regulations. And the price for those regulations is going to be paid by bank customers, people buying insurance, and investors. In fact, the American Action Forum has taken a look to see what effect a designation of an asset manager could have on people's investments and their retirement savings. And it's troubling. I mean, this is not free, but we think it's free. And then, of course, at the end of the day, the taxpayers are also going to be on the hook because when the government promises that it's regulating something the way it's doing with these big systemic institutions, it's basically implying that it's guaranteeing that they won't fail, that it's guaranteeing their success. And so if we think Fannie and Freddie were bad, we're creating a whole new set of Fannie and Freddies. And so taxpayers could be on the hook. Another area where we see the regulatory-centric solution is the new Consumer Financial Protection Bureau. And again, these are people who are really well-intentioned. They think that they can protect customers. And Don Boudreau mentioned that it's really difficult for someone sitting at a regulatory agency to figure out all the different preferences of the people it regulates or the people it's protecting. And what I would say is they're not even trying to figure out the preferences because they know that whatever people prefer is not right. And so they're trying to substitute their preferences for the people's preferences. So we end up with regulations that sort of direct everyone towards one type of financial product that the regulators at the CFPB think would be appropriate. So we get one-size-fits-all products, and we see the people paying the price are often the people who can least afford the price. Consumers are having less options, and they're paying higher prices. Now we can all say, oh, well, yeah, I don't like payday loans. They have such a bad reputation. Manufactured housing, I don't like manufactured housing, i.e. mobile homes. They have a bad reputation. So really people shouldn't be using those products anyway. And so we don't care if we're making the price higher for those products. But the point is that those people, if they can't go to a payday lender when they're in a really serious financial need, they're going to have to go to someone who's in the black market for lending, which means that the punishment is physical harm instead of a higher interest rate. And so that may not be the world we want to create, and we have to think about those consequences on people. The third example I'll give you of how regulations affect people is just in the area of securities regulation. So we've heard a lot today about how the economy is not growing as fast as we need it to be growing. And one of the ways that economies grow is that you have new businesses starting and you have existing businesses growing and expanding. And you have people with innovative ideas getting those ideas into the marketplace. But one of the necessary factors in that growth and that expansion is, of course, money. And so you need to have an easy way for people with money to meet people with ideas so they can come together and build something bigger and something innovative. But the Securities and Exchange Commission is very skeptical of anyone who's trying to raise money to fund a business. And it's sort of an inherent conservatism, because if anything goes wrong, they're going to get blamed. And if things go right, no one's going to say, hey, wasn't it great that the SEC set up this regulatory structure so people could get funding for their businesses? And so the SEC has dragged its feet, dragged its heels, dragged and pushed back and said, we don't want to make it easier for people to raise money. So finally, Congress came in and said, okay, we're going to have to push you along. And Congress did push the SEC along, but the SEC is still resisting and still trying to put in obstacles to make it harder for people to use these new capital raising rules. And the consequence is that people aren't getting hired, businesses aren't expanding, and we're seeing lower economic growth. And so that's a real travesty. So in terms of what to do about this, I think some of these solutions that I'm suggesting were also suggested by Doug Holtz-Eakin this morning. But one is that economic analysis of rules before they're adopted is a very helpful way to sit down and think about what's the problem we're trying to solve. Does the government even need to solve this problem? There are different alternatives for solving it if the government's going to solve it. Let's look at the different alternatives. Let's look at the costs and benefits of each. And so if you do that analysis beforehand, you can prevent bad rules from being put in place in the first place. A key piece of this is that agencies often like to do things through very informal rulemaking, and so you have to be very careful that they're not using informal means of rulemaking in order to avoid having to do economic analysis. A second thing that agencies should be required to do in order to make sure that the rules are working is to have them do retrospective review. So after a rule is in place, they'll go back and look, hey, is it working? Is it creating unintended consequences that we hadn't thought about? An important feature of retrospective review, in order to have it be effective and not gamed by agencies, is that you want to build metrics into the rule when it's adopted so that the agency says this is how we'll measure success or failure 5 years down the road when we go back and look at it. And then finally, I would say that we need to consider revisiting how courts review what agencies do. Right now, courts are very deferential to whatever decisions agencies make. And I would argue that you need to have a much more heavy burden on agencies to prove that what they're doing is the least liberty-limiting alternative that they could be choosing. Because regulation should always be a last resort, because it does have these costs and it does have these unintended consequences. And so the courts need to have a stronger way of checking what agencies are doing. Now, agencies are really free to choose whatever regulatory approach they want within the statutory parameters. And as you might expect, they often choose a very regulatory approach when there could be a less regulatory approach that would work better. Thank you very much.
Okay, we have a little time for questions. I thought I'd just ask the first one real quick. Hester, you worked on the Senate Banking Committee during the Dodd-Frank moments, right? So I guess what I'm wondering is, did that legislative dance elevate the kind of concerns that you are identifying now with respect to consumers and financial products? Were there any, I hate that word, but stakeholders who were coming up to members and staff during the deliberations and the markups and so on, saying, you should not do this because of these kind of concerns? Or were there any outside organizations that had them centered to their, in their bullseye, saying, here's what we have to do to avoid the kind of downside risk you spoke about? And Dino, feel free to jump in too. In other words, these guys work in this world. If something, the next time we have to go through one of these situations, is there any confidence on our part that there'll be a voice to represent these kind of people who are going to be on the short end of that stick?
Yeah, I mean, I think that's one of the unfortunate things, is that it's people who have a direct stake that are more likely to come in, and often the people who will be hurt don't know that they'll be hurt. And so we have a situation where we have a lot of the stakeholders, and I too hate that word, who were most active in lobbying were the regulators themselves, who were so eager to increase their regulatory authority. And then you had a lot of groups who paint themselves as being consumer advocates, who come in and they argue for this very regulatory approach, which will make it more expensive for the lowest income consumers to get credit. But in their mind, it goes towards solving a problem of, they see abuses and they say, well, this is the answer to abuses, when in reality, competition is the best way to fight abuses of consumers in these markets. You want to have as many people fighting for their business as possible. Mm-hmm. So, it was one of the most depressing times, honestly, to be on the Hill during Dodd-Frank, because that statute was put into place without normal order hearings that you would have leading up to try to figure out what caused the crisis. Instead, there was this rush to do something, this urge to do something. And it was legislation by slogan, and I think that's something that you all can push back against in your role as staffers.
Yeah, maybe I can tell a story just from CEA. And I was at the Council of Economic Advisors in 2005, 2006, so it's before Dodd-Frank. And your last briefing at CEA is to give the next group a heads up what's coming down the pipe. And I said, you should see what Dodd and Frank are thinking about. And and people were knocking on our doors about provisions that ultimately got into Dodd-Frank even during that period. And in terms of, I was happy to be an economist at that time and see how being able to highlight for non-economists in the administration the consequences of what on its surface look like good rules. It was fun to, I'm kind of a political geek in addition to being an economic geek. And I remember, when we started getting lobbied, I loved it. I thought, man, we're being lobbied. This is great. I write about this stuff, and now it's happening here. At the White House, the people have the best suits. They're the A-team. And Ben Bernanke was our chair, and he would just sit silently and listen, and he wouldn't say a word. And he would hear the pitch. He'd let us ask questions. And on a number of occasions, the door would close. We'd thank the lobbyists. The door would close behind them, and he'd turn to us and he said, "We're not doing that." Right? And what was happening was that the president really appreciated having those insights from economists of, here's the superficial effect of the regulation. Here's what's going to come down the pipe when you're not looking. And to have that understanding in your back pocket can be a real good foil against distributional lobbyists.
All right, now I'll turn to you guys for questions, and I just ask when we call on you if you just identify yourself in your office, if you haven't already. So, questions?
are there some specific provisions in laws that have already been passed that you think could be improved upon, or are there some specific alternatives that you think that staff could recommend in the way of reforms to improve the ability of entrepreneurs to access the kind of capital that we'd like them to be able to access?
Yeah, well, if I had my dream world, we would have a real re-examination of the securities laws, because obviously a lot has changed since the 30s when we got our securities laws. And so you've got ways for people to connect with each other that you didn't have, and I'd like to see a rethinking of the laws in light of that. And then also it's much easier for people to find information now, and so we might want to reconsider a lot of our disclosure laws as well. But I am optimistic that some of the new options for small private offerings will be helpful. Just this past week, the SEC finally adopted, it's called Reg A+, which allows for small securities offerings. And then a lot of people are eagerly awaiting crowdfunding rules, which should be helpful in allowing people, right now people can put their profile up on the internet and can raise money, but they can't give people any stake in their business. And these crowdfunding rules would allow that, although unfortunately, what the SEC does and what a lot of people's their intuition is, we need to put a lot of regulations around this to make sure no one gets ripped off. And I can promise you, when crowdfunding goes up, we're gonna have people get ripped off, because that will happen, that's life. But we have to encourage people to be skeptical. Investor skepticism is really important. We cannot tell people that the government is gonna vet all these investments for you. You have to make your own decisions. And so I'm worried that whatever rules we get will be so laden down with purported investor protections that investors won't be able to take advantage of crowdfunding at all.
You talked about the idea that if everybody has to follow the same risk profile in terms of who they lend, then maybe where we're at right now is a situation that might be even worse than 2007. That we might be in a position right now where all risk has been systematized, that risks are much higher, that we might be in a much more dangerous position right now. Can you, both of you, maybe follow up on that?
Yeah, I agree with that. Hester leads our financial markets working group, of which I'm a member, and I said in one of our meetings, we have Basel I capital requirements that were supposed to, make the banking sector a safe sector, and it didn't. So then we had Basel II, and now we're thinking of Basel III, and I suggested that we take out Basel and we replace it with the name strike. So we have strike one, strike two, and we're on strike three. To your point, that it hasn't worked before, and so we're thinking about what sort of alternatives might we create. And you mentioned earlier in your opening remarks about full cost accounting. A lot of these things, the cost benefit analysis of something like these capital requirements, it's just the math is hard to do. So set aside the distributional interest problems that we highlighted in our panel and previous panels have highlighted. Just the math is pretty hard to do. There are ways that you can get around this to get at the local knowledge through information markets, for example, where you can get a better idea of how do markets really think about systematic risk. And even if it didn't inform regulation per se, what it can do is it can inform participants in markets of, hey, you know what, the waters look like they're calm, but there's some indicators that the system's a bit more fragile than it appears on the surface, and you can get better allocation of resources, at least on that margin.
Yeah, I think those market-based alternatives really build on something that Don Boudreau was talking about this morning, which is it's really impossible for a government to gather all the information and to process it in the way that markets can. And so Dino's written about creating instruments that would allow us to take advantage of all of the market information and use that to assess systemic risk. But Richard, to your point, absolutely, I would say we're in a worse place, and it's because now not only do we have banks crowding into the same investments, but because we're regulating insurance companies and potentially asset managers, similarly, because the Fed is kind of taking over regulation of bigger and bigger sectors of the economy, we're going to have all of these people herding in the same direction, whereas before we had some variety just because of regulatory differences. And to make it even worse, we have a lot of our regulations actually being generated internationally. There's this Financial Stability Board, which creates these mandates effectively for individual countries to then go and implement these rules. And so now we're getting bureaucrats in Europe telling our bureaucrats what should be done here. And one could argue that there's a lack of accountability there to Americans, to American taxpayers who will foot the bill when some of these policies fail.
In the audience? Yes.
Actually can make a huge difference. Because agencies are forced to consider comments, you really, if you write, I mean, if you're sending in a comment letter that's the same, you know, there are a lot of these form comment letters that are generated, and so if you're one of 20,000 letters that are saying the same thing, it's not going to have that much effect. But if you really take the time to write a careful, well thought out letter, it can make a difference. You know, certainly if you provide data, it can make even more of a difference. And getting that stuff on the record is so key, because later if there's a legal challenge and there was something in the record that they should have considered but they didn't, it makes it much harder for the agency to survive the legal challenge. So I'm a big believer in comments, even though recently the SEC was pretty embarrassed because they lost one of the comment letters, and they had to admit after they had done the rule that they hadn't considered this, and they had to reissue the rule based on having considered the newly found comment.
And along those lines, does the Chevron standard mitigate the value of comments, or how does that play into the deference that's supposed to be accorded to the experts in all the agencies?
Yeah, I mean, Chevron deference is what I was referring to before, and that name comes from a case upon which it was based. And it does, Chevron deference does make it much harder to prevail against an agency, but agencies aren't supposed to do things that are arbitrary and capricious, and if you're ignoring something that a commenter stated clearly, then you could be faulted for being arbitrary and capricious. And in the case of the SEC, for example, it actually has an economic analysis requirement built into its statute, which is relatively unusual. And so people have successfully challenged the SEC based upon that economic analysis requirement. And then, you know, based on what's in the record, they're able to point to things in the record tied to that.